The Capricorn climax ended in 1993, and a new cardinal climax would next arrive in the year 2008. And this cardinal climax from 2008 would last through 2015. In other words, every year after 1993 was another year after the Capricorn climax, when Saturn, Uranus, and Neptune, the moon's north node, all crossed one another in the sign of Capricorn. That doesn't happen too often. Every year after 1993 was 1 year closer to 2008, when Pluto would enter Capricorn, and Saturn would begin its opposition to Uranus, the first two steps leading into a remarkable planetary configuration with Saturn, Uranus, and Pluto all entering the early degrees of cardinal signs. You'll see that on this chart here, Saturn moving into Libra, Pluto's already moved to Capricorn, Uranus moving into Aries. That's why it's called a cardinal climax. Jupiter would join it in June of 2010. So 4 of our 5 furthest out planets would all move from mutable signs, which are planning, into cardinal signs, which are action. The last time this happened was 1930 and 31, the time of the greatest economic crisis of the 20th century. It was due to return. And as we look at these astrological cycles, we want to look at the financial markets and see where opportunities and solutions might lie, as well as dangers in your investment program. Let's start with a discussion on the Saturn-Pluto cycle, because I think if you understand this cycle as a backdrop to everything we're going through and look at it piece by piece, you'll be able to see what type of investment program you need to protect yourself, and realize that what's going on right now between the central banks and the government are policies that are the kind of opposite of what we would expect during this part of the cycle. The 32 to 37-year cycle from conjunction to opposition, it happened in 1946, 1966. It happened in 1982 to 2001. This is a cycle where we notice there's more prosperity. Interest rates are low. Debt is reduced both individually and in terms of the government. There's lower taxes. The mantra at this time is appreciate capital through investing in equity markets, stock markets rise. And that was certainly the case from 1982 to 2001 during the waxing phase. Now here we are in the waning phase, the opposition to the conjunction, 1966 to 1982 and 2001 to 2020. Okay. This is a time when increased government spending takes place, increased government debt, increased deficit. Well, we've certainly seen that since 2000, 2001. I mean, President Obama complains he inherited a mess. He's right. He inherited a mess. He inherited a $800 billion mess, which he saw and rose to $1.4 trillion. It's risky what's going on here. Increased government spending and debt and deficit, eventually it's going to lead to higher interest rates. Fortunately, the Federal Reserve is bucking that. They're keeping interest rates at 0 to 0.25%. Believe it or not, at least in my opinion, that is saving us. That is saving our markets. Rising taxes, they're coming. They're not here yet, but fortunately they stayed low, and that's also helped it. Economic recessions are longer and more numerous. Normally during this phase of the cycle, our mantra is to save our money, protect our capital. But what's happening, because interest rates are so low, because deficits are so high, you're punished if you're saving money. Your income that you have in savings is only generating about 0.2 to 0.3%. If you're in bonds, you might be getting 3%, depending on how far out you are. Okay, let's look at the stock market now. We don't have enough history to say exactly how long the long-term cycles are, but there does seem to be evidence potentially of a potential 90-year cycle. It bottomed in 1932. Before that, it was 1842. Before that, it was 1762, which is only 80 years. But big drops at those times you'll see short when I pull up the long-term chart. There's also a 72-year cycle, and I'm not sure which one's more dominant. I would think the 90-year. The 72-year also bottomed in 1932. It was next due again, the bottom, in 2004, give or take 12 years. Now, what does this mean? That means when these cycles hit, it represents the steepest decline since they began. And we have had this. We have now seen the steepest decline in the stock market since 1932. The stock market dropped 54.5%. The previous biggest drop was 1973-74 when it dropped 46%. So we've already satisfied the minimum criteria for this long-term 90-year and 72-year cycle. We've had the biggest decline. However, historically, these declines tend to be 77 to 93%. So far, the Dow has dropped 54.4%. The NASDAQ dropped 80% back in 2002 under this cycle. But the Dow hasn't yet, which is a concern. They each have half cycles. The 45-year has a half cycle that last bottom in 1974. It's due in 2019, give or take 8 years. The 36-year cycle also bottomed in 1974 because they have a range of 1/6 of their cycle. It's due again 2010, give or take 6 years. I think we just saw it. I think we just saw the 36 and 72-year cycle. However, I don't think we've seen the 90 and 45-year cycle, which is why I think we're going to get a double dip in the stock market and probably the economy. If you look at these times in the past, 1761, we were followed 21 years later by this low in 1782. It was a lower low. The second low was a lower low. Then we had this big drop. Remember Andrew Jackson, 1834, when he dissolved the Fed, Federal Bank, and the market dropped 80% into 1842. And the U.S. did default on its debt temporarily. But we had a secondary bottom in 1857, 15 years later. Then we ran up to a new high in 1929, followed by a 90% drop in the stock market into 1932. We had a good rally after that, but then we had a secondary bottom here. Actually, it was 1938 and 1942. And then we continued up. I expect the same pattern to happen again. This is the 72 and 90-year cycles piggybacking after each other. And so I think we just saw the 72-year cycle, but I think within the next 10 years, we're going to see a 90-year cycle. I don't know if it's going to be lower than what we just had or not. Depends whether or not we get this hyperinflation. I do think that the percentage decline will be higher than 54.4%. But getting a 70% decline from 20,000 is not going to take out the 6,000 low that we just had.